The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Oil retreats, consumer confidence stumbles, and equity traders try to capitalize on it all. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Emily Griffeo. We're kicking you off to the closing bell here in the U.S. on a day where we're about 24 hours away from that key earnings report from Nvidia. We are seeing equities higher right now. The S&P 500 up about 0.3%. As oil falls, we now have Brent down about 4%. Speaking of down, yields are moving lower. This is the second day in a row to see that 10-year yield moving down here, 4.6%. Bitcoin as well, something to highlight. It did top 80,000 for the first time in quite a while. It's in the green, but it is coming off those session highs, Romaine.
Absolutely here, but that drop in oil prices is feeding into the drop in Treasury yields, providing a modest bounce for stocks. Take the price action, though, with a grain of salt. Volume is even weaker than the day before, breadth even narrower. Tech stocks higher and a smattering of healthcare names, too, but not much else. Call it more of a holding pattern, if you will, ahead of a consequential 3 days up ahead. Starting tomorrow morning, that PCE report projected to show stagnant income gains, slowing household spending growth, and core inflation still pinned above the Fed's 2% target. Forget this, a 65th straight month. Then on Wednesday night, we hear from Nvidia. We get their earnings, and we get a read on the sustainability of those AI investments that are not only responsible for the majority of U.S. stock market gains this year, but close to 3/4 of U.S. GDP growth. Now, adding to the caution was a consumer confidence report that we got this morning that showed folks out there, well, today say the economy is tolerable, but they think that things tomorrow will actually be worse. Of course, it's not all bad out there. You do have phenomenal earnings growth for the S&P that is outpacing the advance in the index itself. Elevated yields, they're still nowhere near crisis levels. And while the AI spending may feel a bit out of control, some of that promised productivity gains and ROI, they are indeed starting to materialize. But I do want to go back and just take a quick look at that consumer confidence data. We're going to have the CEO of the conference board in just a minute. But there is an interesting divergence here. The idea that, well, people are feeling confident about the here and now, but not so confident about what's around the corner. And that is actually the similar backdrop that we're seeing actually play out in the markets. You see that in the price action. A lot of euphoria, or at least a lot of optimism about the short term, but a lot more trepidation about the long term. Abby Joseph Cohen has seen quite a few economic and business cycles, a legendary economist and financial analyst, now a professor at the Columbia Business School, also, of course, former partner and chief U.S. strategist over at Goldman Sachs. And Abby, I do want to start off talking about what the market is kind of telling us, because we talk about equities, of course, right now, still camped out near record highs. But then you look at some of the moves that we've seen in Treasury yields, which seems to suggest, at least among bond investors, that they're a little less sanguine about the longer-term picture. What do we pay most attention to? What should we?
Well, Romaine, you've laid it out quite well in your introductory comments. Basically, this is an equity market that is being driven, at least for now, by very favorable earnings outlook. We've had great reports, and the expectation is that many of the leading companies will continue to be very profitable, strong margins, strong returns on equity. However, when we look at the rest of the economy, things are looking okay, but not great. And that's what those consumer confidence numbers are saying to you. We basically see, for example, that middle-income consumers are not feeling all that great about either their own financial situation or prospective employment and wage gains. And that's something that's quite telling. Among the things to be looking at, by the way, will be a real-time metric of consumer confidence. And that, of course, is consumer spending. Back-to-school sales will be important, but let's keep in mind that many of the retailers are trying to juice up those sales by doing their Halloween offerings very early. So that's something that will make the year-on-year comparisons a little bit difficult to read. Yeah. We're also looking at a situation where the consumer balance sheet is looking more awkward than it has in the past. We see an uptick, for example, in subprime borrowing for autos, for example. And let's not forget, we're now seeing the pinch from some of those changes that were made in that big omnibus bill that was passed in January 2025. We know that many middle income and lower middle income households have lost their medical insurance coverage. And that, of course, says something about whether they can afford to be spending on other items.
I do want to go back to the consumer spending thing. And this also gets to a lot of questions about the economic data we get and how reliable it is in the moment. I was looking through a lot of the corporate earnings that we've had, particularly among some of the folks in the retail space. And they have not necessarily been good. I mean, we're going to talk a little bit later in the show about Dick's Sporting Goods, which missed because of higher promotions that it had to make to get people back in the store. Last week, Walmart posted its slowest comp sales growth in about 6 years. On Holding, Under Armour, Nike, you name it. A lot of these companies in their most recent earnings report seem to have suggested a choosier consumer and a consumer for some of them that isn't choosing at all. Should we pay more attention to what we're hearing out of some of these companies rather than maybe what the official economic data says?
I think it's important to look at both. You know, those retailers that you cite are very important because these are the large public companies. But one of the things that the aggregate data from the Commerce Department picks up is what's happening for mom and pop retailers. You know, what's happening for those retail companies that are not included in the market indices. And those numbers don't look particularly good either. You know, we see that personal consumption spending is, you know, just about 2%, 1.8%. That's not as robust as we might like. In fact, when we look at aggregate GDP numbers, where is the vigor coming from? A lot of it is just coming from business fixed investment. And even there, it's primarily equipment, which is growing something on the order of 11 or 12% on an annualized rate. Business fixed expenditures for structures, buildings, is actually down 4%. So this is an economy that is very uneven in its growth, and the middle income, lower middle income consumers are not where the vigor is, not at all.
Well, this is also an economy, Abby, where we're seeing so much spending on the build out of artificial intelligence infrastructure. How do you kind of see that weighing on pricing pressures and economic growth going forward?
Well, there are so many different ways to slice and dice that. I'm glad that you asked that question. First of all, there is the accounting question that is very comparable to that cross-holdings situation in Japan in the 1980s, where there's the circularity to a lot of the accounting, where different companies in the industry or related industry are basically borrowing and lending money to one another, and it shows up in some cases as earnings and in other cases as prospective revenue. So that's one thing to keep in mind. The second thing to keep in mind is whether there is, in fact, a sustainability to some of what we are seeing, particularly when it comes to growth in data centers and also growth in expenditures on some of the chips and so on. Now, look, I'm not at all saying that there's not something very unique happening, a structural change as it relates to AI and so on. However, we also have to keep in mind that some of the spending that we're seeing and some of the accounting that we're seeing may not be sustainable.
Yeah, talk a little bit more about that. Is it already clear to you what sectors, what companies are starting to become the winners versus the losers of this AI race?
There are other people who are very close to this situation who have identified winners and losers. I think we look not just only at the companies, but we also have to look at the geographies, which are the communities and which are the countries that are likely to do quite well in this environment. You know, AI has much promise to it. What we've not yet seen is whether there has been a boost in labor productivity. That certainly has not come through, at least to this point. Maybe it's too soon. So that's number one. Number two, we see that many of the companies that have invested heavily as customers in AI say that they are continuing to spend, but they have not yet seen the benefit to themselves. So To answer your question, at this stage, which is pretty early still, when you talk about a technological innovation that is hopefully going to have positive impact throughout the economy. The beneficiaries thus far have been the suppliers and the providers, and we have not yet seen it in terms of an economy-wide process.
When do you think, though, we'll start to see that gap between the amount of AI investment and these productivity gains? I feel like past cycles, we've seen this before, where the spending far outpaces the gain, the returns, but eventually it catches up. I mean, what is the lag time historically? What does that tell us?
Well, the most recent period, of course, was the 1990s with the so-called TMT, which was internet, telecom, media, communications, and so on. And there the lag time was something on the order of 2 to 3 years. We also have to keep in mind that the economic data didn't keep up. Because many of the economic statistics were tracking some of the older companies that were not participating. But there's some fascinating work going back in economic history, looking at the canals of the 1820s or the railroads of the 1840s and 1850s, electricity generation in the late 19th and early 20th century, and so on. And there, very often, the lag was measured in terms of many, many years. I don't think it's going to take that long this time. I think we're looking in terms of 1 or 2 years. And if the heavy spending doesn't lead to propitious results for a particular company, one can assume that they will cut back, or at least they'll try to rationalize the spending that they've been doing in this category.
Professor, I do want to get your thoughts on the Jackson Hole meeting, which kicks off this week. Kevin Warsh's speech on Friday, ostensibly about financial innovation and payments. I assume people are going to be looking for something maybe a little bit different than just what that headline suggests. But you started your career inside the Federal Reserve, and I am curious that when a new chair, I should say, steps up to that podium for the first time, who are they speaking to? Are they speaking to the audience in the room? Are they speaking to the market? Who?
Hopefully they're speaking to all of us. Mr. Warsh, as you know, did not get rave reviews from the markets when he did his first post-FOMC meeting press conference. And the argument at that time on the part of many was he didn't really provide very much information or guidance. And the sort of guidance that the markets are looking for is not to be told, gee, we're going to do this or that to interest rates in a very specific time frame, but at least to understand what the variables are that he's most interested in looking at. And I do think that we will be hearing more of that, if not short term, at least what he's looking at intermediate to long term, number one. Number two, also structure. He has spent a good deal of time thus far at the Fed thinking in terms of whether the Fed is handling itself appropriately when it comes to things like communications, regulatory oversight, data collection, and so on. And I hope that we hear more of that. And the third thing, too, is that the attendees at this meeting come from all over the world. And I'm hoping that he will have an opportunity, not just in that public speech, but of course behind the scenes in private meetings with other central bankers, for them to come to some understanding of what they're all looking at, what they're concerned about, and how they think they can do better moving forward. And when I say better, I'm talking in terms of coordination, communication, and also, dare I say it, risk control. You know, one of the things that the central bank in any nation has as its responsibility is to think about what to do if things go wrong. Now, that might be a very low probability scenario, but it's something that we expect central bankers to be prepared for, not just in their own countries, but also as they work with one another. As the Fed handles the central banking for the world's largest economy and largest banking system, what Mr. Warsh tells everyone, both behind the scenes and in front of the camera, in this regard is really quite important.
All right, Abby, I have to leave it there. Really appreciate you joining us Abby Joseph Cohen, of course, needs no introduction, one of the greatest minds in the world of business and finance, professor now at the Columbia Business School here in New York. Now, coming up, we are going to talk about those consumer confidence numbers and a bit of a crisis in that confidence. We're going to talk to the CEO of the Conference Board about some of the divergences we're seeing in that data.
Plus, from public sentiment to private markets, Mitch Caplan, the CEO of Willow Wealth, joins us live to sift through the IPO pipeline and lay out the next phase for alternative assets.
And we're going to talk about AI, but on the impact of education. McGraw Hill, remember them? They used to make books. Well, they've transformed a lot. They got a new CEO, and he's going to be joining us later on in the program to talk about how the technology is finding its way into the classroom and on to his income statement. All that and more coming up in a bit, right here on The Close, right here on Bloomberg. Welcome back to The Close. Emily, markets trying to rebound a little bit from some of the doldrums that we saw the last few days, only up about 0.2% on the S&P 500, but maybe a bit of a holding pattern as we await quite a few catalysts, let's just say, for this market over the next few days.
Yeah, I mean, Nvidia's the big earnings that all of Wall Street is waiting for. Interesting news out of Bloomberg this morning, though. OpenAI said that its new jalapeno chips performed better than Nvidia's current lineup during testing.
Yeah, I was watching VTech on
Yeah.
this. I was a little confused because I thought they were talking about something else, but they held it up. It's rather large.
It's not edible.
But we'll see there. We should also point out, as we're speaking now, a redhead crossing the Bloomberg terminal, also on OpenAI, and this has to do with their head of data centers, Chris Malone, leaving the company. We've seen quite a few departures, actually, from OpenAI over the last few weeks, last few months, really. I don't know. We won't read too much into that, but something to keep an eye on as they, in theory, prepare for an IPO. Maybe this year, maybe next year. Who knows? We are going to hear from Nvidia tomorrow. So we're going to get another read on the AI trade. And I'm kind of interested to see more about what Jensen Huang says about the long-term trajectory of some of this spend and the competition in the chip space. You know, it's not his world anymore.
It's not his world. They were obviously the poster child for the AI trade, but actually if you look at how a lot of the chip stocks are performing, they are lagging now. They're only up like 15% year to date versus some of these other names that are in the triple digits. Well,
Nvidia trying to get its mojo back today, snapping a 7-day losing streak ahead of its earnings report tomorrow. Meanwhile, we did get some earnings this morning from Dick's Sporting Goods. They weren't good. The shares plunging today by about 30%. A lot of it has to do, of course, with that Foot Locker tie-up that, well, let's just say a lot of investors said they didn't want them to do. That conversation coming up next, right here on The Close. Let's get right to our top calls, the big movers on the back of analyst recommendations. We start off with AMD, an upgrade over at Raymond James, too strong buy. The price target goes to 641. The firm saying AMD provides the strongest combination of direct earnings leverage and is better equipped to capture the growing market for CPUs than rivals ARM, Intel, and Nvidia. Shares up 5%. Next up, Dynatrace, Morgan Stanley, upgrading to overweight, saying the infrastructure software company benefiting from the healthiest market from so-called observability services since 2022. Those shares up about 2% on the day. And finally, Sherwin-Williams, D.A. Davidson initiating coverage with the buy, saying the paint retailer is actually boosting earnings with no help from the housing market. Sherwin-Williams shares up 1% on the day. Those are some of our top calls. Let's go to Dick's now, one of the biggest decliners out there on the day. A huge plunge down 30% after the athletic goods retailer cut its sales outlook, citing pressure from the Foot Locker chain it bought back in September. Joining us right now is Anthony Chukumba, Managing Director, Senior Research Analyst, and Consumer Sector Head at Loop Capital Markets. They closed this deal almost just about 1 year ago, September 8th. But I do want to go back when they announced that deal. It was pretty widely derided. Dick's was a pretty healthy company on its own. Foot Locker was struggling. Two different footprints, big box store versus mall stores that Foot Locker had. They told us this would be accretive to earnings in fiscal 2026. So far, it's not. What's going on?
I mean, it's very simple. They never should have done this deal. Period, full stop. And they never should have done this deal for a number of reasons. I'm just going to point to two. First off, why buy the cow when you can get the milk for free? Foot Locker has been bleeding market share to Dick's for years. They would have continued to do that. Second off, everything that they were doing was working, right? Dick's House of Sport, the Field House stores, continuing to gain market share, had all the big brands. So this deal was nonsensical. It was just a matter of time before it blew up spectacularly, and that's what we saw today.
So give me a sense here. Is there a path where they can sort of right this ship? Is it just closing more Foot Locker stores, or is there something else they can do?
Yeah, that's a great question. I'm not sure I have a great answer. I mean, certainly closing more stores. Listen to this. Foot Locker has stores in 20 different countries, 20. They have 5 different concepts. It's nonsensical. And what's really interesting is when Dick's reported earnings last quarter, and Foot Locker actually had a pretty decent quarter, had positive comp store sales, and they increased their targets for the year, they said, you know what, we're probably not going to close as many stores as we originally thought. But yes, closing stores is definitely going to be part of it. Getting out of probably a ton of these countries is definitely going to be part of it, and probably maybe getting rid of a concept or two.
What about maybe considering getting rid of the business entirely? I mean, that seems kind of unprecedented, but is that on the table?
It's not on the table right now. I can almost assure you it will be on the table. And by the way, for the record, you brought it up, not me. And look, the reason that I say that is that I've seen this movie before. This is Dollar Tree buying Family Dollar back in like 2014. Within a year and a half or so, it was clear it wasn't working. And you know who had 2 thumbs and wrote a report basically saying they should sell that business? This guy. Now, it took them a lot longer than I anticipated to do it, but that's what ultimately happened. And that's probably what's going to happen here. That's what should happen here. I don't think it's going to happen anytime soon, but honestly, I believe that's the end game.
That's the end game. So I just want to make sure, and I know we're kind of pinning everything on this quarter on to Foot Locker, but it's kind of interesting to see a lot of the peers in this space get dragged down, whether it's other retailers or some of the actual shoemakers themselves, like a Deckers and Nike. Should we not read anything into the declines we're seeing there?
There's probably a little bit of a read. I mean, one of the things that they said was that there is this buildup of inventory in the channel, and so everyone's getting more promotional. That can't be good for anyone. But when you look at the reduction in the guidance for the full year, it really was in Foot Locker. I mean, they trimmed their numbers, their earnings numbers, a little bit in the core Dick's business, but the vast majority is in Foot Locker. But I think it's fair to say that there is some read-through, to a Deckers, to a Nike, to an Academy Sports.
I'm sorry, we got 30 seconds left, but I was actually trying to furiously find your note from back in May of 2025. Sort of left you scratching your head, was what that said. I guess, is that why you lost all your hair, Anthony? I love you, man.
Being in the retail industry for 20 years is the reason I lost all my hair. Before I got into the retail industry, I had a full afro.
All right, we got to get you back soon for a longer conversation. Anthony Chukumba, one of the best in the business, Managing Director, Senior Research Analyst, and Consumer Sector Head at Loop Capital Markets. This is Bloomberg. 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Boston.
And I'm Emily Grafeo.
We started out this morning, Emily, with a look at consumer confidence data. It came out at 10 a.m. New York time, and it was kind of hard to know exactly what to make of it.
Right.
Because on the surface, it didn't look awful. I mean, the confidence index did deteriorate ever so slightly, 89.4 in August from 90.2, and the consensus was that it was actually going to increase slightly. I was a little more interested, though, in the disparity between how people feel about what's going on now and how they feel about what they think is around the corner.
Right, because they feel pretty good about right now, and that's despite the fact that we've already had rising energy prices, consistent inflationary price pressures. It just goes to show, what does this mean for the months ahead, really? Absolutely. Well, who better to pose that question to than the CEO of the Conference Board? Steve Odland joins us right now. He's also the former CEO over at Office Depot and AutoZone. All right, Steve, I just want to get right to it, particularly with the numbers with regards to expectations. Present situation, that index actually rose 6.8 points to 121 and change. But the expectations index fell about 6 points down to 68 and change. That's a pretty huge disparity. Why?
Yeah, so the Conference Board's Consumer Confidence Index is made up of those two subcomponents. How are people feeling right now about their present situation? And then what are their expectations for the next 6 months? Interestingly, they're feeling kind of okay now. There's relatively full employment. Their wages are good. They're rising. They're making their their paychecks are coming in, they're making their payments, but they're worried about the future. They see this inflation coming, and it's starting to wear on them. So it's gas prices, it's food prices, and as we know, oil not only impacts gas, but it impacts plastics, rubber, pharmaceuticals, makeup, 6,000 different consumer products. So you have rampant inflation. Then you've got the two wars that are going on in Ukraine and Iran with seemingly no end, trade issues. It just goes on and on. So they're worried about the future, and that's the big disparity. Okay, we're good now, but where are we going?
Well, it raises a question, too. I mean, is this just sort of a real turning point in, I guess, what we can expect out of consumer behavior? Or is this just more people's anxiety just sort of being reflected in those numbers right now?
It's a really good question because, as we know, 70% of our economy is based on the consumer. So this is an important thing. And right now, their debt levels at 1.3 trillion are as high as they've ever been. They're worried. Majority of consumers will say that borrowing costs will go up. They think interest rates are going to rise, which means their credit card costs are going to go up, their car costs are going to go up, their mortgages are going to go up. So I think this is what they're worried about. And, you know, when you've got about half the country living paycheck to paycheck, if this keeps happening, inflation keeps going, they're not going to be able to afford things.
Right. So do we have an understanding of how this actually trickles down into consumer spending, into economic growth? Because a lot of times, you know, what consumers say is not necessarily what they are always doing.
Yeah, it's true. They don't always do what they say. But look, you know, these are economics, right? I mean, they're coming to the end here of their flexibility with debt. Their costs are going up. They're worried. You know, when you've got people living paycheck to paycheck and the huge number of households that are doing that, there isn't a lot more here. So if this keeps going, you know, what's going to happen? And that's what they're worried about. We can deal with it the way it is right now. But if inflation starts going any more than where we are, if interest rates rise anymore, we're in trouble. That's what they're telling us.
I do want to get your thoughts on, you know, one of the data points here that the confidence was highest for survey respondents under 35. What do you make of that?
Yeah, you know, I think that, you know, those people are largely in single-person households. They're taking care of themselves. A lot of them living at home. You know, it's a different generation, and they don't have the same kind of worries. They don't have families and mortgages and car payments the same as, you know, people who may be later on. That's what we chalk it up to more than anything. You know, there are regional differences there, you know, where the costs are higher. You see that on the coast, you know, the confidence is lower. But that is an interesting point. And, you know, we'll see how that plays out. They aren't the biggest spenders in you know, of all the generations.
Well, I am curious, Steve. I mean, we had you on this program, I think, about 3 weeks or so ago to talk about CEO confidence, which wasn't great, but it was rising back above that 50 level. And I'm curious, does it matter that we're seeing CEO and corporate confidence going in one direction and maybe consumer confidence going in the other?
Yeah, consumer confidence has been drifting down since the end of 2021. CEO confidence, you know, took a big hit here with the war and the situation with oil, supply chain, and so forth. You know, CEO confidence is barely above neutral, you know, at 52. And, you know, now we've got the consumer confidence still drifting down. If the consumer confidence continues to drift down and you see them cut spending, then you will see CEO confidence go down because, of course, their sales will go down. So this is all intertwined.
Well, I mean, maybe you could put your old retail CEO hat back on. And I know Office Depot and AutoZone probably a little bit more necessity than discretionary for a lot of folks out there. But when you look at a report like this, or really the string of reports that the Conference Board has put out here, heading into what is supposed to be the time of year where most retailers do pretty well here, do you look at this report and think to myself, as a CEO, I've got to cut prices or cut inventory or do something to adjust to what might actually come?
Yeah, most retailers are looking at the holidays right now, and you've got most inventory on the water by now in order to get into the system, through the ports into the system. So everything's been ordered. I think you're going to see people going, okay, well, if this is where we're at, we're going to have to start promoting faster and earlier. So I think Christmas is going to start in October this year, and we'll see. You're going to have sales all through.
Well, Steve, they got to get the Halloween stuff out of the way first, which by the way, in my neighborhood is already up in some of the stores for some reason.
Yeah, it's a great American holiday now, and a wonderful retail holiday. But you're going to have to watch retail margins this holiday season.
All right, Steve, got to leave it there. Yeah, it'll be interesting to see how early some of that. I feel like the last couple of years, the Christmas stuff was out way early and all the promotions, but we'll see what happens later this year. Steve, we'll catch up soon. Steve Odland there, CEO of the conference board. All right, when we come back here on the program, we're going to unpack what's behind some of the super moves in super microcomputer. Hey, 9% jump on the day. That's our stock of the hour. It's coming up next, right here on The Close, right here on Bloomberg. Our stock of the hour is Super Microcomputer. The share is up about 8% on the day after Cisco said it would partner with the company to use its cooling hardware in its Nvidia-powered AI infrastructure stack. Joining us right now is Woo Jin Ho, Senior Analyst for Hardware and Networking at Bloomberg Intelligence. And I do just want to point out, 8% gain for any other stock, of course, is phenomenal. This is a stock, though, that has had ups and downs of 10% or more on like 20 different occasions this year alone, Woo Jin, as it's sort of worked through a lot of issues, including some of those corporate governance issues. But I need you to explain exactly what Cisco is doing here and why they would choose Supermicro.
Yeah, hey, thanks, Romain. So really quickly, it's essentially Cisco is looking for a server partner to go with their networking gear. So you're essentially pairing up the largest networking vendor globally with one of the market leaders in the AI server space.
So what is it bringing to Cisco's AI offering that Cisco couldn't really provide on its own?
Well, I mean, Cisco has a very small server business, but it really doesn't have the scale and the manufacturing capacity as Supermicro does. I mean, if you think about it, Cisco's server business itself, it's really not a line item on their income statement. But if you look at Supermicro, they're on pace for about 65 to $72 billion for fiscal 2027. So there's a massive amount of scale that Supermicro can provide, and Cisco is the one that wants to connect it.
I thought it was interesting too. I mean, in the press release, I mean, Cisco was talking a lot about this idea of managing costs and controlling data. Maybe you just kind of give for us lay folks out there, Woo Jin, kind of paint a picture of why this is becoming more important and why it kind of opens up the aperture for companies beyond sort of the core ones. Like Nvidia and into some of these other players?
Yeah, so that's a great question, Romain. If you really think about how these systems are starting to be built out, you can create quite a bit of sprawl. That's one. And then number two, in terms of data management as well as network connectivity, Cisco is a market leader in terms of that. So one of the things that Cisco has been really trying to do is leverage their software to help manage the data and help create the single pane of glass of data operations for the network operators inside a corporation. So, Cisco, look, as an enterprise IT leader, they want to provide that management leadership that Supermicro doesn't provide right now.
There's some concerns on Wall Street of AI circular financing, of maybe too many partnerships, AI infrastructure spending getting ahead of demand. But when you look at this partnership, does it seem sustainable?
Yeah, well, look, Emily, this right now is just a partnership, right? At the end of the day, and we'll see where the partnership takes them. I've seen partnership announcements come and go, but in terms of quite frankly, who they're trying to serve, they're trying to serve the neo clouds as well as the sovereigns. And I believe the press release specifically pointed out sovereign deals. And we know that Cisco has pointed out sovereign wins on the networking side. And Supermicro's bread and butter are neoclouds and sovereign. So this is something that could be sustainable.
I do have to ask you just overall, Woo-Jin. I mean, we talk about a stock that is trading about a third of where it was just a little bit a while ago. That was obviously because of some of the allegations surrounding some of its business practices. We learned, of course, what was it, just a few days ago about that internal compliance review into those GPU export violations. Is this now being, put behind them? And more importantly, are investors willing to give them a pass on some of this and focus a little bit more on the potential growth opportunity?
Yeah, there are two separate answers for that, Romaine. So from a customer standpoint, customers are not going to lay out $65 to $72 billion in revenue for them to, if they thought it was a concern. But from an investor standpoint, valuations are quite low relative to Dell and HPE. So investors are still concerned.
All right, Woo-Jin, always appreciate it. Woo-Jin Ho over at Bloomberg Intelligence, who covers these companies for us. Partnership between Cisco and Supermicro, that's sending Supermicro shares up about 8% on the day. Meanwhile, for the broader market, fractional gains for most of the major indices with yields down, oil down as well. We're going to catch up with Kristina Hooper at the Man Group when we come back after the break. This is Bloomberg. Just about 10 minutes until we get to those closing bells, Emily. I don't know if you call this really a rebound from some of the doldrums. Fractional gains, and we should point out volume is incredibly light, as it typically is here late in August. So that might change tomorrow morning.
That might change tomorrow morning, and it might change into the close tomorrow, because of course that's when we get the all-important Nvidia earnings. Everyone is just waiting to see whether, this AI company that has really profited from such a boom in this technology can keep those gains continuing. Take a look at how markets are trading right now. We have about 10 minutes left to go. S&P 500, like you said, Romaine, it's in the green, not much, 0.3%. Oil is down in a big way, though, down about 5%. That's dragging Treasury yields lower for a second day in a row. And then I do want to point out Bitcoin. It is lower now, but it did top 80,000 earlier in the trading session. So a little bit of risk on there, but of course in the red right now.
Absolutely here. Of course, tomorrow could be a consequential day. And don't forget, of course, we get the Jackson Hole speech from Kevin Warsh on Friday. A closer look at some of those yields, drifting lower for a second straight day, despite a lot of the concerns right now about the fiscal situation in the U.S. And of course, all the talk about some of those attempts by the Treasury Secretary, Scott Bessent, at least for right now, to try to put a cap on some of those yields. It's an interesting move. And we actually heard from Scott Bessent's mentor, Stanley Druckenmiller, probably one of the most successful investors of our generation, out with an op-ed earlier today where he basically said, this is not going to work. But more importantly, he talked about this idea of letting the bond market speak. And he talked about this idea, how markets aggregate information that no committee possesses. Prices are how that information reaches decision makers, and that the long-term Treasury yield is the most important price in the world. It's the only fiscal disciplinarian that the U.S. has left. On that note, I do want to bring in Kristina Hooper. She's the chief market strategist over at Man Group. And Kristina, I do want to start there because, I mean, despite sort of, some of the drama of you have the mentor sort of, admonishing his protege, Druckenmiller really does bring up something important, which is about the idea that the markets often are a lot more prescient about where things are and where they're going than maybe the official economic data, and often whatever the Fed is doing behind closed doors, and the Treasury for that matter. Is there room right now, you think, for the market to actually be heard, given some of the moves that Bessent has made effectively against that?
Well, what's been done thus far is not very significant. So there certainly is room now. But if we were to see continued operations, if we were to see something much larger, I think that would be extremely problematic, especially since we have a new Fed chair who believes very much in a laissez-faire approach to markets. And he said he wants markets to tell the Fed what to do, not vice versa. So that's going to be problematic if we have Treasury over here manipulating markets in some way and bringing down yields on the long end.
Well, that's what I'm curious about. The point you bring about Warsh, I mean, he's been pretty clear about this. I mean, for a guy who's not very clear about a lot of things, he's been clear about that. And I do wonder if there could be a conflict brewing between the Treasury and the Fed. But also this idea, and I'm just going to quote someone we had on Bloomberg television earlier today, who kind of said this isn't really a bond market tantrum. They basically just sent Scott Bessent an invoice and said, look, we'll buy, here's the price. So, I mean, that's not going to change. The invoice is there. They've made it clear what they need to see on a yield level in order to buy into some of these long-term auctions. What can you do to push back on that?
Well, it's hard to. And quite frankly, I think the trajectory is higher. I think that investors are going to demand more as we move along, just because the deficits aren't going to get smaller. Overall debt isn't going to get smaller. And you also have all these other issues going on at the same time. I think for foreign investors, they have to very much be worried about risks that they may not have even thought about in the past. One being, is there the potential that one day they could anger the U.S. enough to have the U.S. stop paying interest on the treasuries they hold? You know, there are just so many different, I mean, that the beauty of the concept of term premium is that it is incredibly amorphous. Yes, there are components that are far more tangible, like inflation expectations, and then there are components that are just a catch-all of different reasons why an investor would want to own treasuries or would not want to. And of course, that all gets priced in. And I think now we're headed upward because the risks are growing.
So do you think then that inflationary pressures are maybe not as relevant to Treasury yields if we get a softer PCE, if we continue to see that trajectory that we've had in the last month of inflation readings, it's not really going to do much to bring yields down?
Well, I certainly think on the margins, and especially in the shorter term, it could. But I think longer term, and really more even just in the next several months and beyond, we're going to see yields go higher, not lower in this environment. Keep in mind, we continue to have AI-related corporate debt issuance. That is also taking away some of the potential buyers for treasuries, or at least forcing up yields further.
What does it mean for the Fed?
Well, that's a far more complicated question and answer, because we just don't exactly know what the calculus is for the Fed yet, right? And perhaps we'll get some of that in the Jackson Hole speech this Friday. But right now, what it seems is that the Fed is looking to markets at least the Fed chair is looking to markets to tell him what they believe is happening. But what we have is a number of other FOMC participants who seem ready to hike rates if inflation remains at this level or moves higher. I mean, I think the FOMC minutes were quite stunning in terms of the numbers that are very, very predisposed to hike rates.
So what do you think, I guess, what do you want to hear from Warsh on Friday? You may not get it, but what do you want to hear out of him? And are you concerned that he might make a mistake communication-wise?
Well, I'm not concerned that he might make a mistake. And I will give the caveat that these working committees, I think he refers to them as task forces, were only put together several months ago. So, I mean, ideally, it would be nice for them to have reported back and him come back with recommendations, policy proposals, talk about sort of, the mechanics of how he wants to, quote unquote, modernize the Fed. I just think that that's unrealistic to anticipate, just given the short timeline. So he could very well just be laying out some broader policy goals. It could be somewhat similar to his speech after the first FOMC meeting. Now, we could get some things like, we're going to have fewer FOMC meetings, which seem to come from the minutes. We could get some specifics like that, but I think it's going to be a view from 40,000 feet.
All right, Kristina, I have to leave it there. Kristina Hooper, Chief Market Strategist over at Man Group, counting us down to the closing bells. Stocks up fractionally on the day, yields down. So too is oil. A full breakdown of all of today's market action starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And And right now, we are 2 minutes away from the end of the trading day. Romain Bostic here with Emily Grafeo, taking you through to that closing bell. It's a global simulcast. Tim Stenovic joins us alongside Nora Melinda. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube. Fractional gains on the day for the major U.S. indices. Tim Stenovic with yields down, oil down as well, the dollar flat on the day.
Yeah, I'm glad you went to oil. That's exactly where I'm looking. We see Brent down about 5% right now, 4.5% lower for WTI. But we were just talking about gas prices. I mean, it's still high relative to where they were just a few months ago. I mean, you still have these benchmarks up more than 40% this year. And the AAA gas price average up to 410 right now, or close to 410. So that's something that folks are watching closely ahead of these midterms.
Yeah, another thing that they're watching closely is that AI trade, with a lot of folks looking ahead to Nvidia earnings. Tim and I earlier in the show on Business Week just talking about the fact that this used to be a market Super Bowl, still a very consequential earnings report. But, you know, when you see a little bit less concentration, you start to see investors looking in other places as well. But if you take a look at the SOX index as we're heading into the closing bell,
SOX
up
Remember
about
when
1.4%.
Joe Weisenthal had didn't they have a watch party somewhere at some bar in New York?
I believe it.
Yeah,
it was a different
times.
time. It was a different time, Romain.
Kids about that.
Now there are a lot of ways you can look at the AI trade, right?
Absolutely.
Yeah, sure.
I'm always here working. I'm not partying.
We should point out we are going to get some earnings from the software side out of Intuit and Zoom. Box also set to report, obviously a little bit less consequential than Nvidia, but we'll bring you those numbers as soon as we get them. Meanwhile, the numbers for the broader market, mostly in the green on the day. The Dow Jones Industrial Average, the S&P 500, each up about 0.3% on the day. The NASDAQ Composite and the NASDAQ 100, each up about 0.6% on the day. And the Russell 2000 getting in on the action on the day, up about 15 points, or about 0.5%. We are getting a few earnings out right now. Intuit actually crossing the wire right now. Net revenue in its most recent fiscal quarter coming in at about $4.35 billion. That does appear to be a beat based on the average of estimates collected by Bloomberg. But here's your forecast going forward. The company says that for the full fiscal year that has already started, 2027 fiscal year, revenue will be in a range of $23.28 billion to $23.51 billion. The low end of that range is right around the average of street estimates. Average operating income for the full year, $8.06 to $8.15 billion. That's below the average of street estimates, which were tracking closer to $10 billion. EPS, the range is 22.8 to 23.12. The street, that's well below what the street was looking for. They were looking for about $27 a share.
And shares taking a hit in the after hours now as a result, down about 11%. Remember, this is the company buying TurboTax, Credit Karma, QuickBooks, MailChimp, Intuit, Enterprise Suite, and more. I mean, this is a company down 46%, Emily, since this year. I mean, it's a consequence of the so-called SaaS-pocalypse, at least as of now.
Yeah, it's been tough for those software names. I do want to get back to the regular trading session, though, before we get back to earnings. Just taking a look at kind of how sectors fared out. It was mostly green when you look at the IMAP and the S&P 500. Information tech, communication services, materials, those were the leaders in terms of the S&P 500 groups. What was lower? Energy, we know that. Oil down about 5%. So those energy stocks getting dragged down. Staples and industrials also lower.
Okay, we're waiting on a few more earnings, including Zoom and Box. We'll bring those to you as we do get them. In the meantime, do you want to take a look at some stocks that were higher today? In the S&P 500, the best performer was Moderna, up 14%. This after last week's rally. Shares cruising higher this year, but still down just about 60% from those 2021 highs, all-time highs in the COVID world. Shares actually moved higher today as a result of what happened last week. Wolf Research out with a note upgrading the company to peer perform from underperform, citing the success of its melanoma vaccine trial. Analyst Alexandria Hammond saying the positive trial results de-risk the platform for Moderna. Shares of Moderna up, the best performer in the S&P, 14% today. Also, taking a look at shares of Nvidia ahead of that report tomorrow. Nvidia shares higher this year by about 14%, so outperforming the S&P 500, up 2.2% today. This is the biggest increase or excuse me, this is an increase based on today's move, up more than 2%. The big question tomorrow: what is the state of the AI industry? Yes, there's other ways we can look, but Nvidia is still the big player. What are the company's efforts to remain at the center of the AI frenzy? And finally, one of the most actively traded stocks today, Resolve AI. It's a company with a market cap just shy of about $2 billion. Shares were up more than 21% today. We can go ahead and round that up. The company did say Google has selected its proprietary distributed database technology for deployment at the infrastructure level within Google Cloud. It marks the platform's first major commercial deployment. Investors cheering that news. Shares up close to 22% today.
Well, there were a few names in the red as we closed out. Following that closing bell, I'm taking a look at shares of Dick's Sporting Goods. A brutal day for this company. Shares of the company down about 31% on the day. That's the worst day ever for Dick's Sporting Goods and its lowest level since 2023. This all comes after the Foot Locker chain that it acquired last year, showing that it's continuing to struggle and really raising broader doubts about the sneaker market, the sneaker industry. The company is saying that the footwear market has become increasingly promotional last quarter. That's after brands upped discounting on their own websites. And the company is seeing a shift to brands like Uggs and Birkenstock. If you take a look at shares of Nike, also falling down about 3% after the closing bell. And we know Nike is a supplier to both Dick's Sporting Goods and Foot Locker. So certainly seeing some investors shifting out of that name.
When was the last time you were in a Foot Locker, Nora Melinda?
I was just talking about this earlier with Tim. I can't remember the last time I was in a Foot Locker or the last time I was in Dick's Sporting Goods.
Wow.
Yeah. I tend to be
online. Dick's not
just,
huge in New York.
Yeah, well, Dick's is big. And the thing is, like, we talk about this idea of a company, when they made this announcement back in early 2025, May of 2025, it was pretty widely derided. I mean, Dick's was growing. It was growing 4, 5, 6% on a comp sales basis. Foot Locker was shrinking. It had a negative sign in front of its comp sales number. And everybody said, why would you buy this company? And now here we are more than a year later. And, well, those questions are still being asked. I mean, we had Anthony Chukumba on from Loop Capital, who, I mean, he was pretty blunt, Emily. He basically said, I don't know what the heck they're doing.
Yeah,
and I'm cleaning it up, family friendly.
And you have to remember too, like how much of this is also just due to that weakening consumer. We do have some earnings though, Romaine.
Yeah,
we have to get to.
Let's zoom in on Zoom Communications in the most recent quarter. It does look like most of the metrics did come in either in line with estimates or slightly above. For the second quarter, revenue of about $1.28 billion. The street was looking for about 1.27, so a slight beat there. Similar story on the adjusted EPS basis. But let's go straight to the guidance for the full year. For the full year, the company says that for the full year revenue, look for a 5.09 to 5.10. So basically $5.10 billion. Its previous guidance was for roughly about 5.09, so slightly raising that just a bit. Similar story on the operating income side. It had given a range of 2.07 to 2.08. The previous estimate was for 2.07, so the top end of that range coming in slightly above that. Most of the numbers pretty much track in that same vein here, basically either just above street estimates by a few bucks or so, or maybe just right in line. The shares lower by 4%.
All right, you're watching Zoom. I'm watching what's happening with Box in the after hours. The shares for Box, the content management platform, down about 8% in the after hours. Taking a look at the company's latest report, the outlook, the company's seeing fiscal year adjusted earnings per share about $1.54. They saw about $1.56. The estimate was for $1.58. So that coming in light, shares down about 6.4%. In addition to that, the company sees fiscal year revenue coming in at $1.29 or $1.29 billion. Saw $1.28 billion. The estimate was $1.28 billion. So as far as the outlook goes, a beat on the top line, but a miss on the bottom line. The company sees third quarter adjusted EPS about 39 cents. The estimate was for 39 cents. Second quarter revenue coming in above estimates at $321.1 million. The company sees Q3 GAAP EPS at 12 cents. That matches expectations. Shares down about 4.6%, 4.5% in the after hours.
Let's get some questions too. I mean, you look at Box and Zoom and Intuit, obviously three different companies, but to a certain extent, kind of all dealing with some of the same issues with AI and some of the new tools that are out there that to a certain extent chip away at some of the moat that they might have had. And, I don't know how far this goes. I mean, we had a great analyst on from Goldman yesterday, Gabriela Borges, who kind of talked about this idea that the SaaS-pocalypse is overdone. them, and that some of this AI build-out will actually end up benefiting them as it will actually increase usage on some of their platforms.
We've had some folks talk to us about that as well, but we're not seeing that play out in the public markets yet. And look, every company is different too.
Yeah,
right?
and don't forget, we had, everyone's talking about Nvidia tomorrow. We get Salesforce tomorrow as well.
Yeah.
I'm sure they'll get overshadowed, but definitely an interesting read on that side of the trade.
All right, Salesforce shares, at least this year, have still taken a pretty big hit, down about 22%.
You're a Slack guy, aren't you?
No, it depends. I mean, it depends on. Yeah, I have Slacked before. How's that?
Okay.
But I'm all about the Bloomberg terminal. And
he's an IB guy.
It's Hermie.
Bloomberg. Come on.
Tom Secunda thinks.
What's a Slack?
Yeah.
All right. All right, guys, we got to go.
Yeah.
We'll see you tomorrow.
See ya.
That is going to do it for our cross-platform coverage. We'll have Nvidia earnings tomorrow. We will have also, of course, Salesforce earnings tomorrow. We'll see you same time, same place.
Our coverage continues here on Bloomberg. We're going to talk about Wall Street and whether they're fighting the wrong battle when it comes to retail investors. Mitch Caplan, the CEO of Willow Wealth and former CEO of E-Trade, he'll be joining us in just a second, right here on The Close, right here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Romaine Bostick. A close look here at how Wall Street finished the day. Fractional gains for the S&P, the Dow, the NASDAQ, and the Russell 2000 here on this Tuesday afternoon. Tech led the charge, but healthcare got in on the action too. The NASDAQ Biotech Index up about 1.8% on the day. A part of the upside that we saw in equities because of the downside we saw in yields and the downside that we saw in crude oil. Brent crude prices down about 6% on the day. You flip up the board and take a look at some of the individual gainers on the day. Nvidia snapping that 7-day losing streak, rallying about 2% ahead of its big earnings report just about 24 hours from now. AMD also getting in on the action, up about 5%. That was on the back of an upgrade over at Raymond James. It actually says AMD, not Nvidia, actually has a better chance of capturing some of the upside in the CPU market. Meanwhile, Deckers was dragged down partly because of those results out of Dick's Sporting Goods early today. And Target, well, let's just say another misstep, if you will, down about 4% on the day. And we're going to move now to our top story of the hour. A muddled backdrop for markets. You got an S&P that remains range-bound despite a relatively attractive valuation and roughly 20 times forward earnings. You have benchmark Treasury yields that offer some compelling coupons, but at the same time are flashing yellow lights of caution. The tightest corporate debt spreads in years that would suggest calm, but also offer few attractive entry points for investment. And you got global AI investment that Goldman now estimates will exceed $1 trillion in 2026, though that report makes no mention of when and what the return on that investment will be. So what's an investor to do out there? Our next guest is the former CEO of E-Trade Financial and now runs the private markets investing platform Willow Wealth. Mitch Caplan joins us right now to talk a little bit more about all of this. All right, Mitch, I do kind of want to start just with what we've kind of been seeing in the markets lately, because it's kind of been all over the place. And I am curious as to how investors, particularly on the retail side, sort of behave in these types of situations. Is there anything we can read into it?
Yeah, I mean, I think generally, just from my experience all the way back at E-Trade, that investors are just looking for ways in which they can invest for the long term, right? Like you have your group of investors who are more hyperactive trading. You see it on some of the platforms that still exist today. But generally, what we saw was the evolution of customers really trying to figure out how they build wealth, right? And so whether they're thinking about ways to build a diversified portfolio in public markets, private markets, and, there's a lot of noise out there. And I think that that's the part that confuses retail investors.
With regards to how people are positioning and allocating, and particularly in light of some of the recent developments with regards to the Treasury Department and the move in yields. We've talked a lot on this show. Obviously, the traditional 60-40 was put to bed a long time ago. There's a lot more allocation to private assets. Do you see people, particularly on your platform, reaching more for some of those private assets, given what we're seeing in public bond markets and the equity market, for that matter?
Yeah, for sure. I think generally my experience is that, when it comes to our platform, investors are realizing that if they don't think about private markets, they're missing out on the opportunity to build long-term wealth, right? That's just that simple. And while the market has actually been on fire, as you guys have been talking about all the time for a long period of time in the S&P and otherwise, it's still true that if you're trying to think about the diversification and ultimately building wealth over not a 1 or a 2 or a 3-year horizon, but a 5 or a 10-year horizon, you really need to have access to not only public markets, but also private markets.
I am curious, though, about the competition between yield. I mean, I guess one of the upsides of the increase, at least prior to today, that we saw in yields is, I mean, you get some pretty healthy coupons. If you're the kind of person who's going to buy and hold, why not lock in 5% or 4.7 on a 10-year yield? But that also puts upward pressure on what private assets have to return. I mean, ultimately, people are buying the spread, or at least looking at that spread and wondering whether it's worth their while. If we are in a higher for longer rate environment when it comes to treasuries and benchmark rates here, I guess how much more does private credit and private assets have to offer?
Yeah, so I agree with you completely. You have to offer the premium for the illiquidity, right? At the end of the day, that's ultimately the issue between public and private markets. And so, but generally speaking, when you see behavior with retail consumers, so they're moving potentially away from public equities into fixed income because they want the coupon. The same thing happens in private markets. You'll see a move away from what would be traditionally private equity into private credit where there's yield. And then there's obviously a corresponding premium, as you were just indicating, that you're getting paid for the illiquidity. But listen, I think it's also true that investors realize that there are great companies out there that are choosing to stay private for much longer. And so if they want exposure to the credit of that company and they're not public, then the only way to do it is in the private markets.
I mean, why are they doing that? I mean, I understand why they were doing that maybe a couple of years ago when the path to a public market was a little bit less, I guess, smooth. But I mean, the IPO markets has pretty much opened up. I mean, we're probably going to go down in 2026. It's probably one of the greatest years for capital markets in quite some time.
Yep.
Why choose to stay private if you do have the opportunity to go public right now?
It's interesting. I remember years and years ago in the beginning of my career when I was building the bank, the telebank, everybody wanted to go public and it was a mark of success. And today, I think when and one of the sort of truisms was that you just had a lower cost of capital. I'm not sure that's as true today. And so I think you have a universe of companies who feel like remaining private longer puts them in a better position. They can still get access to very inexpensive capital, and it allows them to continue to invest in the business in the way they see best fit over the long term. So I think you see it. I think there's a universe of companies, and as evidenced by this sort of movement today and all the hot stocks that have gone public at crazy valuations, it's because they have stayed private for so much longer and are really so much further along and advanced in their life cycle around earnings and otherwise. And so it's why they're commanding the kind of premiums that they are.
This may be a dumb question, but I am curious about the duration issue with regards to the lockups that you see in the private space. If people in the public markets are kind of shying away from duration, certainly in public debt markets, and you're even starting to see that to a certain extent in the equity space where people are moving away from some of those long duration trades, does that become an issue for private markets if people are skittish overall about whatever the broader economic market situations that maybe they don't want to lock themselves in for 5, 6, 7 years or whatever it is?
Yeah. So it's a great, you and I have talked about this in the past, and I agree with you, right? Like at the end of the day, when you saw, the movement around redemptions in private credit, I think you and I were both saying at the time, it's not really a credit issue, which people were worried about. It's really a liquidity issue because there's a mismatch in expectation of what liquidity means. But I think you've probably seen it even in the last few weeks. You've seen asset management firms, one in particular that just filed with the SEC to create a level of new enhanced liquidity. There are partnerships that are being built with companies today in the asset management side in NASDAQ and using technology. So I think just as I saw the evolution at E-Trade or in public markets, you're going to see it in private markets, where there really is going to be enhanced liquidity creation as an option, particularly around interval funds for retail investors who want to have access to private markets.
I do want to ask about kind of this expansion of private markets to the individual investor into 401ks and the new deal, Department of Labor safe harbor rules. I also just want to bring to your attention a report that just came out, I think it was on August 14th, out of Vanguard, where they basically recommended an allocation to private equity of 0. I am a little confused by that. I mean, I understand the risk associated with that, but you've built a company on the premise that there should be more of a meaningful allocation to that. Why do you think there would be some reticence to actually recommend that by, and let's face it, Vanguard is the biggest one out there when it comes to managing folks' retirement money and their long-term capital. Why do you think they would be a little bit more reticent?
Well, so remember, though, that at Willow, our platform really serves other qualified purchasers or accredited investors. So by definition, we're serving a segment of the marketplace that wants access to private markets and has enough wealth, either in the form of income or net worth, to be able to bear loss. And so I do understand, I do think that as you start opening private markets into 401ks, you're really reaching into more of what we served at E-Trade, more of, the Main Street and mass affluent category. And it's true. I think there is a level there where you have to be much more cautious and you have to really lean into education so that the end consumer really understands the illiquidity of the investment and what the implication is, right? For us, it's slightly different because we're serving a different segment of the marketplace.
Well, and as you serve that segment of the marketplace and this whole direct-to-consumer model, I mean, you don't have that space completely to yourself. I mean, you've helped to define it, but I mean, you're seeing Blackstone and KKR and Apollo, basically the behemoths in this space, now start to sort of look a little bit down the line here. Does that worry you at all? Are you going to be complimentary to you? You're shaking your head, no?
Yeah, no, listen, I say this all the time. The big part of the amazing success we experienced at E-Trade was you saw us and Schwab and Fidelity and Ameritrade and all the others really trying to build a category and build individual brands within that category. And when you actually have others participating, it really validates the space. And it often makes it much easier to really be able to grow your brand specifically within the category that's being established. And so I sort of welcome the opportunity for more people to enter into the space.
All right. Mitch, always appreciate it. Mitchell Caplan there, CEO of Willow Trade, former CEO, of course, of E-Trade. Coming up, Willow Wealth, excuse me. Later this hour, we're going to talk about the rise of AI and how it's fueling fears of disruption. A conversation with the CEO of McGraw-Hill, Philip Moyer, on how technology is impacting the education sector. Welcome back to The Close. We take a look here at some of the after-hours movers. A bit of disappointment out of earnings from 3 key companies here, Intuit, Zoom, and Box. Intuit, of course, which of course makes the tax preparation software, down about 7% as we wait for that conference call to start. We talk about this idea of AI and how some of those new AI tools are starting to sort of eat into the business of some of these companies, the earnings, and more importantly, the guidance that we got from that company. Not all that reassuring. We'll wait to, though, hear from the CEO and the CFO on the conference call about the longer-term strategy. Zoom in a little bit better shape, but still down about 4% here in the after-hours trade, and Box now unchanged. All 3 of those companies, we should point out, some of their metrics did beat estimates, but again, we're talking about by relatively slim margins at a time when expectations are high. That was what we saw in the after-hours trade. During the cash session, of course, there was a lot of talk about the rebound that we saw today in tech stocks. That includes biotech, but more importantly, in some of those chip stocks. That helped to lift the S&P 500 by about 0.3%, but a lot of those gains were really aided by the fact that we saw a big drop in yields for a second straight day and a big drop in crude oil. Brent crude down about 6%. Of course, the star of the show today, and obviously going to be the star of the show tomorrow, is Nvidia. Those shares snapping a 7-day losing streak. They were higher in the cash session. You can see now over the last 3 months, they've basically gone nowhere, and that is the big concern. A lot of questions about whether Nvidia's earnings are going to give any real indication here about exactly where semiconductor demand is. Do you believe some of those long-term pie-in-the-sky metrics that Jensen Huang will lay out there? Why wouldn't you? So far, he's made good on them. But at the end of the day, we're starting to see strain in some of the customers, and more importantly, in how some of those customers are financing these deals. We'll have full coverage on that tomorrow, about 24 hours from now, when those earnings drop. Meanwhile, we still got a lot to cover here on The Close. We are going to talk about AI, but we're going to do it through the lens of education. We're going to catch up with the CEO of McGraw Hill, Philip Moyer, when we come back after the break. This is Bloomberg. All right, we talk a lot about the AI disruption fears that are gripping a lot of industries out there, a lot of Americans as well. There was a recent study from Pew Research showing concerns rising with the youngest members of the workforce increasingly skeptical that the advances in the technology will lead to widespread job losses. However, when it comes to education, our next guest says AI will actually scale teachers, not replace them. Philip Moyer joins us right now. He's the CEO over at McGraw Hill. He just took over earlier this year, and McGraw Hill, obviously a storied company in the education space. I mean, you know, I'm old enough to remember when it was just books, and obviously hard physical books, and obviously it's evolved a lot since then. Your background is in tech. Is this turning into a technology company? Is it already a technology company?
You know, we serve about 100 million curriculum licenses around the world. We have about 7.5 million AI tools. We're one of the few companies that serves both sides of the education spectrum. You know, in certain cases you need books, in certain cases you need technology, and so we're one of the few companies that provides both on a global scale.
Well, talk about, well, first of all, I have to ask you, I mean, this is back to school season. A lot of schools have started around the country already. The ones here in the New York area will kick up in a couple of weeks here. Give me a sense, though, as to what you've seen so far with regards to what people are looking for. What are the schools looking for? What are the parents and students? What do they actually need in this particular environment?
You know, it really differs student by student and actually grade by grade. You know, you can expose a child to more screen time the more self-regulation they have. In the early grades, we're finding it's not great for children. So in the K through 5 space, when you're teaching literacy, primarily you want a few minutes a week, maybe 7% a week, and mostly done for assessment to be able to get exposed to screen. As you get more self-regulation into the higher grades, you use it for study tools, and then when you get into medicine, you know, as an example, you can do full interactive clinical simulations. And so you've got to think about it like a lens of a camera that can open to the world of screens the deeper you go.
Well, I am curious about that. There's been a lot of talk about just teaching for the new generation. We remember when ChatGPT and all that came out, and it seemed like every school out there basically tried to shut it down. High schools to colleges, everywhere, basically said, we're just not going to allow it. And then it was like a couple years later, all of a sudden you had teachers and professors integrating these AI tools into their curriculum. Has the tide shifted where the educators, the administrators, and for that matter, the parents, see some value in incorporating that into the education process?
Absolutely. I think the most important thing in education is the productive struggle. And if you offload that productive struggle to an AI, it's not a great learning experience. And so what I'm seeing is that educators, first and foremost, the educators need to be educated in how to use AI. And then the appropriateness per assignment. You know, this assignment, you can have AI do some ideation with you. This one, you can use it to correct your work. In this case, you shouldn't use AI at all. We have to teach both the teachers as well as the students when there's productive struggle and when there's not.
I have to ask you specifically about the business and how the embrace of AI for you, for McGraw Hill, when that really starts to contribute to the bottom line and, more importantly, to revenue growth in a more meaningful way?
Yeah, we're really excited because it's already starting to contribute. You know, we have to teach more subjects to more people in more ways than ever before. You know, I like to say that human intelligence has no terminal value. We're going to be growing it for a long time to come. And so for us, it's actually helping us create content faster and in a more personalized way. We're also able to assess a student at a much more granular level. Like, we can tell you with 25 questions, the 400 skills of Algebra 1, precisely where that student is is. Or if we have to do something really complex, like interactive simulations, we're doing AI today. And so it's contributing today.
But you're building your tools, your own internal tools to be deployed. Are you doing that in partnership with Anthropic and OpenAI and some of those large language model companies, or are you competing against them?
Oh, we're definitely in partnership.
Okay.
You know, this past quarter, I announced maybe the first agentic curriculum initiative among all the organizations. You got to imagine, agentic, you can wrap a piece of curriculum and you can join any chatbot. Think of it like in the future, it's going to be like an app store. Knowledge will be like an app store where I can say, I want to learn biology, I want to learn Algebra 1, I want to be able to learn something. McGraw-Hill will be able to join any chatbot conversation, and we've got a lot of excitement coming out of universities and schools around this agentic curriculum, as we're calling it.
But just to be clear, though, I mean, what protects you, or what allows somebody to go through McGraw-Hill rather than just going directly to ChatGPT or Claude or whatever their large language model of choice is?
You know, you can definitely do that. Yeah. But for a lot of things, especially when you're educating a child, you want truth, you want human grounded content, and you want proficiency scoring. So it's not just enough to give some knowledge. Does the child actually understand it? Is there comprehension? You know, in medical, when we do medical grade, we have to make sure that the technology we answer with answers the same way every single time, or else we're not doing education properly in the medical field.
Well, this gets to the screen time issue. I know there's probably a lot of disparity between the younger students and the adult students in college and grad school. But when we talk about the amount of time they're using technology, screens, et cetera, to do their study or whatever they're doing, is there a balance that you found that is maybe the right sort of sweet spot? And I know it's not going to be the same for every age group.
Yeah, I mean, I have to tell you, we're at an inflection point because I think parents and educators, they're disillusioned with screen time. The average school has 2,400 learning tools, and yet we're dealing with proficiency rates that are below where we want them to be. And so there has been a backlash. Over 25 states now have rules against screens in the classroom. And as I said, I think it's the more self-regulation you have, the more screen time you can be exposed to. But most educators, we just came out with an education report, a global education report, where we talked about the fact that 81% of educators want screen time and AI embedded in the tools they already use in the classroom, as opposed to doing a separate tool.
Okay, well, but when we talk about this backlash, I mean, it's pretty severe. I mean, you have parents basically saying, we're just not even going to let our kids use any sort of, technology beyond whatever is absolutely essential. You have kids themselves, going more analog, if you will, analog cameras and things like that. Are you worried that becomes more of a long-term trend as these fears about just AI and technology just sort of enveloping everyone's life? Does that upset your business model?
It doesn't upset it at all. If anything, it actually strengthens our business because, we are one of the few companies that prints globally. Right now we're shipping books to India, to Saudi Arabia, to the Latin America, to all over the United States as children are coming back. And so we're shipping paper materials, but we're also one of the biggest ed tech digital providers in the world. And so we will serve whatever that classroom needs.
I do just have to end this, though, just circling back, though, to the guidance, the fact that you didn't raise it at the most recent earnings report, and the idea of what the runway is. I know you've only been there 6 months, but Wall Street analysts are pretty demanding creatures. And when you start to see more of a return, and more importantly, more of getting that stock price even back up closer to the IPO price?
We're really excited because we've been, hitting and exceeding our guidance that we gave all the way back at the IPO level. And it's been 4 straight quarters since we've been public. We've had 40 straight quarters of growth in our higher ed business. And right now, as we see students coming back to school, as we see the uptake of our tools, we're going to keep looking out to be able to give a good view of the horizon. But we see a lot of wonderful opportunities on the horizon to continue to increase.
All right, Philip, really appreciate you joining us.
Thank you.
Philip Moyer is the CEO over at McGraw-Hill. When we come back, we're going to talk about those U.S. and Canada tariffs. The tit for tat has officially started. We're going to catch up with Lana, Payne, the national president of Unifor, that's Canada's largest private sector union, to talk about those automotive tariffs. That's coming up next, right here on The Close, right here on Bloomberg.
I told the Prime Minister, no deal is better than a bad deal. And we have to go tariff for tariff and dollar for dollar. And it's unfortunate. We had an attack from President Trump on our sovereignty, on our country, on the economy, that we're so integrated. Both countries were both each other's #1 customer. And it just doesn't make sense to attack attack each other.
Ontario Premier Doug Ford on the escalating trade war between the U.S. and Canada. You can hear more of that conversation on Balance of Power, which comes up at the top of the hour. But I do just want to flag exactly how we got here. Prime Minister Mark Carney, earlier today, matching President Trump's tariffs, announcing a 50% tax on U.S. dairy and steel. The Prime Minister also announcing new support programs for several Canadian businesses hurt by the escalating trade war. There are a lot of questions and concerns about where we go next, what the U.S. does with its proposed increase in tariffs, and whether Canada sticks by its guns. Lana Payne joins us right now. She's the national president of Unifor. It's Canada's largest private sector union, which kind of combines auto workers, energy workers, paper workers, and a few other industries that I'm sure I'm forgetting. Lana, you've already been dealing with the tariff situation since the President Trump, I should say, returned back to office just about a year and a half or so ago. With this escalation that we've seen over the last few days, how much worse do you think it can get, and how prepared are your union members for it?
Oh, it's been pretty bad so far. I mean, that's the reality. We've been 18 months dealing with this right now. We've had plants that have been idled. We've lost shifts. And have workers in the United States. This is what makes so little sense about this entire thing. The people that are being hurt by the tariffs are workers on both sides of the border, and the companies themselves, the companies that actually manufacture in Canada and in the United States.
So give me a sense about the manufacturing. There's a lot of misinformation out there as to what Canada relies on the U.S. for, maybe what the U.S. does or not rely on Canada for. So let's just take autos here. When we talk about a 50% tariff on autos, what exactly are we talking about?
Well, right now it is a 25% tariff with U.S. Content in those vehicles being carved out. The threat is that will move to a 50% tariff in January, but it would also include auto parts. And if we get to that place, I can guarantee you within 10 days, the entire North American auto industry would probably be shut down. It is such an integrated industry that we have auto parts that cross the border between Canada and the United States about 8 times a day. It's very difficult to even know what is a U.S. part and what is a Canadian part. And we have been doing this, kind of integrated auto sector for 40 or 50 years. Unscrambling that egg is extremely painful and is causing pain in terms of job losses on both sides of the border. That's why you hear politicians in Michigan and other places saying this has to stop.
In the old days, I used to cover timber paper companies, and the idea of what goes back and forth across the border before it actually gets to a finished product, I think would make some people's heads spin. It also makes my head spin as to how exactly we extricate ourselves from this situation. Talk to me about Mark Carney. When he came into office back in early 2025, he made it clear that he was going to stand up for Canada and push back on what the U.S. is doing. Do you have the economic levers to actually do that, to help your industries survive this, assuming an agreement isn't reached?
Yes, we do. And what you're seeing today is what could be the first part of an escalation in a trade war, or it could be the thing that actually brings this to a head so that saner heads prevail here. The reality is we've taken an approach in Canada up to this point where we took most of the retaliation off of the U.S. We've given a number of concessions. We've been talking about trying to build and have an economic and security agreement as well, in which we would increase energy exports to the U.S. These are things that the U.S. obviously needs from Canada. Our oil goes into your refineries to help build products there. Our aluminum is very important to the U.S. All of these things because we build things together, Canada and the United States. And when you look at the auto sector as an example, right now by putting these tariffs on U.S. automakers, the only winners in this are the Chinese automakers who are out to basically control the world with their automaking. And I think the reality is the focus is in the wrong place. Canada isn't the problem. The problem is, in case of North America right now, we have a shared problem. It's 5 million imports of cars coming into North America that are not built in North America, and there's no supply chain around these vehicles in North America. That is where the focus should be, and that is what we should be looking at in terms of how we bring some of that work to the United States, but also to Canada too.
With regards to some of the relief measures that have been announced, I mean, obviously the counter tariffs, but we talk about 7.5 billion Canadian of support for Canadian businesses, liquidity support for small and medium-sized businesses, grants to speed up projects for some of those businesses hit by those tariffs, employment insurance programs, et cetera. Is that enough? Is there something more? If you were able to go to Carney now and assuming he would just do whatever you said, what would you ask for in addition to that?
Yeah, absolutely. I think there are a number of other things that we can do. You know, the government of Canada and all of our provinces control a lot of money in terms of procurement. They need to get that procurement out the door as quickly as possible so that we're employing Canadian workers building things for our governments. That is one thing we should do. We should be making a call on corporate Canada right now, who also buys a lot of stuff in the world, and making sure that they're prioritizing, you know, Canadian businesses when they're buying things from tissues to trucks. You figure it out, but make sure that it's Canadian. And I would say, you know, getting in line our industrial policies, which is pretty clear right now. We're going to have to do more of that and quickly, but also making sure that we're not just doing EI or employment insurance programs, income security programs. We're doing things to make sure we're keeping people working. That needs to be a priority so that we're keeping this production that is going to be so key when we get through this trade war, and that we're not losing any of these important jobs for the long term.
All right, Lana, I have to leave it there. We'll talk again soon, I'm sure. I don't think this is going away anytime soon. Lana Payne there, Unifor National President. That's Canada's largest private sector general trade union. All right, when we come back, we're going to set you up for what to watch. And, of course, it's a big one, those earnings from Nvidia. This is Bloomberg. Less than 24 hours until the main event. We'll have special coverage starting tomorrow around 4 p.m. on those earnings out of Nvidia. The chip maker today snapping a 7-day losing streak, though as you can see there, the stock's still down over the last 10 days and quite frankly has gone nowhere since its last earnings report. Matt Bryson joins us right now, Managing Director of Equity Research at Wedbush Securities. Let's just get this out of the way. Revenue will be phenomenal. We're talking basically 90+% growth, if not more than that. Similar story on the EPS side. Margins are crazy. What exactly are investors? I feel like there's no way they can satisfy investors. Matt, what are you looking for here?
So that's been the story of the last 3 quarters, right? They keep on coming out with numbers that, as far as I can tell, that they hit the buy side expectation and the stock doesn't do anything. I still think that over the next couple quarters, and I'm not sure if it's this print, if it's the next print, they're going to beat expectations again. People are going to realize that Nvidia is trading at close to 20 times and growing at close to 100%, and that those two things don't make sense. And I think at that point that the stock takes off. That's why my price target is north of $300. It's just, from my perspective, it's when does that realization kick in? Because I don't see anything stopping Nvidia's growth.
Well, give me a sense here as to what that next leg of growth might actually be, because that seems to be some of the concern is that, you know, this is going to slow down. They obviously had effectively a monopoly for a while in this high-end chip space, but you hear so much talk about people now moving away from GPUs and embracing more CPUs for this next leg of the AI trade. Where is Nvidia going to fit into all that if that is indeed the shift?
Yeah, so you've got CPUs being used for inference. You've got Google with TPUs. You've got a more competitive product from AMD. You had SemiAnalysis out today talking about how good OpenAI's Jalapeno is. You know, it's really hard to tell unless you're seeing product deployed from my end, right? So you've got to see Google or Amazon take the product, put it in place. I think the thing to remember here on the supply side, though, is to some extent, at this point, it's not about technology. We have so many shortages, substrate, DRAM, optics, that it's who's set up the supply chain. And I think NVIDIA's done the best job of setting up sourcing. And so you've got this setup where there's all this demand, and it's literally who can put the parts together. And I think NVIDIA's best position.
Well, it does raise a question. I'm glad you brought up the jalapeno. We actually had one of the product heads earlier on Bloomberg Television talking about that. And again, we didn't hear a whole lot about the actual rollout of it. I mean, it exists. I mean, obviously, at least based on what they said, I mean, the performance, if not matching, certainly close to it. But what's the ability to even scale up a new product like that, whether it's jalapeno or anything else?
I think it's really hard. So you've got Cerberus, who doesn't use HBM, so at least they don't have that constraint. But for most of these companies, it's really hard to get DRAM. It's really hard to get supply. And so I think for an OpenAI, it's going to be hard to scale the first generation. And that doesn't even account for the fact that you look at all of these ASIC developments, and look, Google was numerous generations in before things worked. With Amazon, you're really talking about end of second, third generation parts that take off. Cerberus, same thing. They're on Gen 3, and so for new competition, it just takes time.
All right, Matt, I got to leave it there. Matt Bryson, Managing Director of Equity Research over at Wedbush Securities. A nice little preview there of what we should expect coming out of NVIDIA tomorrow. Meanwhile, we set you up for it to watch over the next 24 hours. There's a few other things going on besides that. It's been quite a few interesting couple of weeks when it comes to a lot of the consumer retail companies. We heard from Dick's earlier today. It was not good. We're going to hear from a couple of more tomorrow morning. That includes Kohl's, Abercrombie & Fitch, Bath & Body Works, Williams-Sonoma, and then we'll throw J.M. Smucker there. Kohl's and Abercrombie could be interesting here. Abercrombie, which had been having a bit of a renaissance, hitting a few speed bumps, and Kohl's looks like, at least based on BI, might have gotten its mojo back. After the market, we are going to hear from NVIDIA. But guess what? There are other earnings besides NVIDIA. Salesforce can report, and that's going to be just as consequential. CrowdStrike, HP Inc., Okta, Synopsys, and Agilent also set to report as well. On the economic front, we are going to get those weekly MBA mortgage applications, and we're going to get that PCE report, personal income and spending, that all important key measure that the Fed looks up, that core PCE inflation data. And we're going to get some Fed speak out of Richmond Fed President Tom Barkin. We will have top-to-down coverage for you from all of that, starting with Bloomberg surveillance in the morning and wrapping it up here on The Close with those earnings out of NVIDIA. Please do join us. In the meantime, stick around. Balance of Power is up next.